Welcome to the NAFA webinar series, providing you with timely information and training on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today we are presenting Leading Retirement Researcher Makes a New Case for Low-Cost Reverse Mortgage, sponsored by Reverse Mortgage Funding, LLC. With me today are Tom Dixon and Dr. Wade Pfau. Dr. Pfau is Professor of Retirement Income in the new PhD program for Financial and Retirement Planning at the American College, which educates financial planners. Wade is also the Director of Retirement Research for McLean Asset Management and InStream. Wade has won numerous awards for his research on retirement issues from the Journal of Financial Planning, the Retirement Management Journal, and the Academy of Financial Services. And Tom Dixon is the founder of Financial Experts Network. He has been educating financial advisors and consumers since 2007. He created the Financial Experts Network to make subject matter experts from academic and professional circles available to educate advisors and consumers on complex and evolving financial topics. Leading retirement researchers have concluded that today's low-cost reverse mortgage can improve a client's retirement income efficiency, retirement sustainability, and their legacy. And today you will learn how you can truly improve the probability that your clients can meet their goals, as Dr. Pfau shares his academic research on how the strategic use of today's lower-cost, FHA-insured reverse mortgages, also known as HECMs, can improve the sustainability of a client's retirement plan and create a larger legacy. Dr. Pfau will show how HECMs can be used to create liquidity from an otherwise illiquid asset, improve retirement income efficiency, and create a buffer to sequence of return risk. And Tom will join Wade and will use Money Guide Pro to demonstrate how HECMs can help clients to pay less taxes by reducing withdrawals from IRAs, serve as a lower opportunity cost alternative to SPIAs, and refinance conventional mortgages, and optimize cash flow when downsizing. During the webinar, you may type your questions in the question box on the right side of your screen. All questions will be answered during the question and answer session at the end of the webinar, and this webinar is being recorded, and a web link to the webinar recording will be emailed to you within 2 business days. Tom, welcome to the webinar.
Great, thanks, Brendan, and thanks all for joining us today. Again, Tom Dixon here, and on behalf of RMF, also known as Reverse Mortgage Funding, we are very pleased to sponsor today's very important webinar. And just for clarification, I manage the Financial Advisor channel for RMF, and the Financial Experts Network series that was previously referenced is now known as the Retirement Experts Network series, now sponsored by RMF. I would also, so our history as a firm briefly is we, as a management team, our team used to run the reverse mortgage business at MetLife, and I referenced that or introduced that fact because we supported what really has been foundational research that we're very excited to have Wade get involved in the last 18 months or so. Initially, research started by Harold Avensky and John Salter. We have been proponents and advocates of this research, and again, are thrilled to have Wade's involvement as well. I would also, just for clarification, I'm not sure we have time today for me to demonstrate some examples of Money Guide Pro. I'd rather err on the side of giving more time for Wade to go through his research and some facts about the product. If you have interest in that, my contact information is included in the materials, and I certainly would be delighted to do a one-on-one session with you to share some of that, and I think you might find that illuminating. So, again, thanks to all for joining, and it's my pleasure to hand it over to Wade. Wade, thank you.
Thanks, Tom, and thanks, Brendan, and it's a pleasure to be here today to talk about reverse mortgages and more generally as a retirement income tool, how they can fit into a responsible retirement income strategy. And that's really the purpose today. I'm excited to announce as we get going here that I'm now beginning down the path of trying to write some books. And the first book in a series about retirement income will be on reverse mortgages. It's It's available now for pre-order at Amazon, and it will be published on October 3rd. But if you go to Amazon now and just search for reverse mortgages, it will show up on the list of books available there. And well, this is a lot of material to fit into an hour. I will have to move quickly through certain parts that I'd really like to give more attention to. But for the most part, all the slides I'm presenting are also discussed in detail in this book. So in order to talk about reverse mortgages, I do want to spend a couple minutes just to provide some background about why retirement income planning has developed as a distinct field in financial services. The field of retirement income planning is only about 10 years old, and there's still a lot of confusion and debate about the best approach to building a retirement income strategy. The financial services industry tends to get into silos so that there's investments and then there's insurance. And retirement income planning is really about how to straddle the two. And the reason that it's different, so speaking to people who focus only from the investment side, the investing for accumulation or for trying to reach a wealth target is a different matter than investing for retirement. And this context is important because it really also will help to explain how a reverse mortgage fits into the retirement income plan. So when we talk about retirement, some of the things that are different, it all really boils down to people have less risk capacity, which means their lifestyle becomes more vulnerable to a market decline, that a market decline could cause a permanent reduction to their standard of living. Some of the reasons for that, they lose this capacity to continue work or to maybe save a little bit more as a response to a market decline. They now have a visible spending constraint where pre-retirement, they're adding new savings to their investments. Post-retirement, they're taking savings away from their investments, and if there's a market decline, to meet a spending goal, they have to sell a bigger percentage of what's left. And that leaves a smaller asset base that even if the market recovers after that, the portfolio does not get to enjoy the full recovery. That's the idea of sequence of returns risk. And that spending constraint, that sequence of returns risk, leads into this point 3 about heightened investment risk. That really the practical implication of sequence risk is that investment volatility really has a bigger impact on a retiree than on a pre-retiree. That really when you look at, if you're using a financial planning software program running Monte Carlo simulations, you don't really see what was the investment return that led to a particular outcome. But if you're trying to plan for a 90% chance for success or something like that, well, in retirement, the implied investment return behind that is going to be lower because of the heightened impacts happening through sequence of returns risk. Retirees also have to deal with not knowing how long they're going to live, and so they need to have a plan for this unknown longevity. They need to be able to plan for spending shocks, where even with a long, even if they have their budget over the next, say, 30 years for retirement, there can be a lot of surprises and a lot of new types of surprises that become more prevalent related to things like healthcare, long-term care, and so forth. And with a long retirement, even low stable inflation can be a problem. And then there's the issue of declining cognitive abilities as well, whereas people age, their ability to do basic financial literacy type calculations decreases. So Dirk Cotton at the Retirement Cafe blog gives this analogy of, often when I talk at conferences, this is what breakfast looks like at the conference. And what he says about this, the chicken was involved in this breakfast, and the pig was committed to this breakfast. And that's really the difference between retirees and pre-retirees. Pre-retirees are like the chickens. They're involved in their financial plans. But once you make that transition to retirement, you become the pig, and retirees need to think like pigs. And that's the analogy he gives. Retirees really are more committed to their financial plan. They have less risk capacity. Their lifestyle becomes more vulnerable to something going wrong with their financial plan. So retirement risks, I just talked about them. This is just expressing that in a slightly different way, where we have longevity risk as the key overarching risk of retirement. Because if the retirement ends up being short, it's unfortunate, although it's not going to be very expensive. There's not going to be time for these other risks to become a problem. But with long retirements, then you have to worry about macroeconomic type risks, including sequence of returns risk, interest rate volatility, change in tax rules, and so forth. Inflation is a macroeconomic risk, but even a low, stable inflation rate really can compound over time. And then personal spending shocks, unanticipated impacts on the budget that require additional spending. So in managing sequence of returns risk, there's 4 different ways to manage sequence of returns risk, and we can start to build towards understanding how reverse mortgages can play a role. First, spending conservatively. That's the idea behind things like the 4% rule. The 4% rule, I think it's not so conservative when interest rates are as low as they are today, but it was designed based on planning for a long horizon the retirees are unlikely to outlive, and also basing it on the worst case scenario from rolling periods in history. How low did the spending rate have to get to be sustainable? That's the idea. Spend conservatively and you reduce sequence of returns risk. Now, I'll talk more about reverse mortgages soon, but the reverse mortgage tenure payment actually fits in here as a way to reduce the spending needs from the portfolio to help the portfolio to be spent more conservatively. Next, spending flexibility. That's things like Jonathan Guyton's decision rules, where if there's a market decline, you cut your spending. That can help to manage sequence risk. You can also reduce volatility when it matters most using insurance, income guarantees, and some different approaches. And then also the buffer asset idea, and that's where the reverse mortgage really found their way into the financial planning research to begin with. That's where you can use a line of credit from a reverse mortgage to spend from that otherwise illiquid asset as part of the retirement income plan and help to preserve the investment portfolio when there are market declines. That same strategy that I'll be talking about is also discussed with life insurance, about using the cash value of life insurance, and then also going back even further to the 80s, just having a big bucket of cash available to spend from after market declines. But I think the reverse mortgage really fits in nicely in this category. With cash, you get the cash drag. With life insurance, well, if you're from the insurance side, you can definitely provide a lot of arguments in favor of having permanent life insurance. But I think even stronger is the idea people need a home to live in. And if they have a home, well, then being able to have the cash opportunity from the line of credit, it becomes a really compelling argument in favor of thinking about a reverse mortgage for retirement. So that being said, that's a little bit of an intro to retirement income planning. And now we can start to see the role for reverse mortgages. I do want to anticipate that discussion a little bit with an overview of how reverse mortgages work. Although really it would take an hour to explain how reverse mortgages how they work in detail. So this is going to be a little bit of an overview. Again, my book discusses this all in great detail, but just the basic idea of how reverse mortgages are going to work. And in leading to that, it's important to address the negative image, that reverse mortgages do have a negative image with the public. Some of the reasons are justified, but some things have changed. The government has changed rules around protecting consumers, making sure the strategies are used responsibly, making sure that consumers do have adequate resources so they're not going to spend on their home equity and then be forced out of the home because they can't make their other homeowner obligations. And then also protecting non-borrowing spouses. Those are 3 big changes that have happened since 2013. That means so the reverse mortgage world post-2013 is very different from pre-2013. And so for any advisor who already did develop a negative image about reverse mortgages, it's worthwhile to revisit that and to consider whether things have changed and it's a much better program today with what the government provides through the HECM program. So some of the negative image related to reverse mortgages, well, if people were not using them responsibly, reverse mortgages could provide a way to quickly deplete assets for perhaps questionable types of expenses that then get that household into much bigger trouble later on in their retirement. And that was an issue. Again, the government now tries to prevent that by having new financial assessments and so forth to make sure that the borrower is able to meet their homeowner obligations. You also see a lot of negative reports about reverse mortgages that were simply based on family misunderstandings, where children thought they were going to inherit the home, and their parents decided to spend that money through a reverse mortgage, and then the children didn't get the inheritance that they may have been expecting, or in some cases just didn't realize. Part of this, what this research is going to show too, you have to remember that money is fungible, and that the legacy that will be provided, it's a combination of the value of the home equity, less any loan balance that needs to be repaid on the reverse mortgage, plus any other investment assets. And for a household that is otherwise spending the same amount, these reverse mortgage strategies can easily increase the overall legacy, even if the home equity portion, well, net home equity minus the loan balance is smaller, but the investment portfolio will be outsized, bigger than the loss to the home equity piece. The overall legacy can be bigger, although the family misunderstanding here would be that the household decided they wanted to spend more in their retirement and spent from the reverse mortgage, and then the children didn't get the legacy they were expecting and then complained about it to the media. It wasn't really generally a fair type of argument to make. But there's now these protections for non-borrowing spouses. The home title, you do not give up the home title with a reverse mortgage. That's a very common misunderstanding. Now more efforts to make sure that the reverse mortgages are used responsibly. In the past, reverse mortgages have had high costs. Still, there are some providers with high costs today, so that you can hear about cases of more than $10,000 just to set up a reverse mortgage. Tom will talk more about that issue because he is with one of the companies I've seen that really does provide the lowest possible upfront costs. That for practical purposes you can cross out this high cost issue. These others, let me just keep going to make sure we have time, but the mortgage program, it is insured by the government, so there is taxpayer risk, and there's just this idea that people, after they've paid off their mortgages, they don't want to have debt anymore. I think that's the wrong way to think about reverse mortgages. It is a debt, but it's a debt backed by the home, and it's not a debt in the traditional sense that it has an ongoing repayment. The repayment can be delayed until the borrower has left the home permanently. Basic issues for reverse mortgages, the borrower does have to be 62 or older, but I think the younger you are, the better opportunities you can get for long-term growth of the line of credit. But you do have to be at least 62 as a borrower. But the closer to 62, the better. You do need to have equity in the home. You can use a reverse mortgage to pay off an existing mortgage, and I'll provide an example of that later. You need financial resources through the assessment to cover your property taxes, homeowner's insurance, and home maintenance. You need to go through a counseling session, have an appraisal from an approved FHA, the Federal Housing Authority that operates the HECM program. It has to be the primary residence, and there is a lending limit of $625,000 and $500. And so the home can be worth more than that, but that's the limit on that portion of the home would be applied to the reverse mortgage. So if you had $1 million home, you can't borrow based on the full million, at least not with the HECM program. You could go to a proprietary jumbo reverse mortgage, but those are not very common. The HECM government mandated or run program is by far the most popular option. And then another point, so I am skipping a lot about how reverse mortgages work. The basic idea, it's a present value calculation about how much you can borrow. The home will be the collateral. You can borrow less than the value of the home with the idea that over time, the amount you've borrowed will grow to be worth the value of the home. And there's this item, the principal limit is the initial amount you're able to borrow. The principal limit consists of basically the loan balance and any remaining line of credit. And all of those factors grow at the same rate over time. So if you've borrowed everything available from the principal limit, it's your loan balance that's growing over time. But if you haven't fully borrowed the whole principal limit, it's the portion that you haven't borrowed, that's your line of credit, and that's growing at the same rate over time. Since the reverse mortgage is a present value calculation, low interest rates mean higher present value, the present value calculation. That means you can borrow more initially, a higher principal limit. And to the extent that if interest rates can possibly go up in the future, I mean, that's not that I'm forecasting that, but at least when interest rates are so low, they can't go a whole lot in the other direction anymore. Well, if interest rates do increase in the future, that would help to accelerate the growth of the line of credit in the future. So that reverse mortgages are one of the really interesting tools that works better in a low interest rate environment. Usually low interest rates are bad for retirees. They're getting less income from their bonds. That's also impacting their ability to earn returns on their stocks. It makes retirement more expensive. But like delaying Social Security claiming, opening a reverse mortgage is one of the few strategies out there that relatively speaking, benefits from a low interest rate environment. You get to spend more, you get to borrow more initially, higher initial principal limit, and then odds are that it will start to grow at a faster rate over time as well. And then with the reverse mortgage, with the HECM, the variable rate program, you can borrow a lump sum. You can set up a tenure payment, which is a lot like an income annuity in that it's a monthly payment. We have to put an asterisk here, not necessarily for life, but for as long as the individual remains eligible and in the home. A term payment is like a tenure payment, but for a fixed period of time. You can also just have the line of credit available that you can spend from as you wish over time and repay as you wish over time. And then modified tenure or modified term is use part of the line of credit to create a tenure or term payment and leave the rest as a line of credit that will continue to grow. At this point, let me just hand it over to Tom for the next few slides to discuss in more detail about the costs for reverse mortgages and also the tenure payments.
Okay, great. Thanks.
This slide. There you go. I think you have control.
I do. Thank you.
Okay.
Thanks, Wade. Yeah. Give me 1 second. Let me bring this back up. Hopefully everyone can see that okay. So, all right, great. So again, Tom Dixon here, and just to expand on a couple of the payment options that Wade just introduced. Frankly, overall, I would say there's a lot of flexibility here in terms of the payment plan or option that you can set up for any given client. And really, like any other product, the products that you work with, it depends on what you're trying to solve for. So there is, just to jump in it, into an example here, there's certainly the option to set up a monthly income stream, and Wade's certainly spot on in the sense that it's very similar to income for life in that, in this example, if it's Mr. and Mrs. Jones, for a one-time cost with this payment option of 125 states in almost every market throughout the country with the exception of Florida, but we're still very competitive in Florida and greater DC, Washington, DC. Again, you can put a monthly payment option in place for the one-time cost of 125. So Mr. and Mrs. Jones decide to do that in this case and on a home worth $625,500, which, as Wade alluded to, is the FHA lending limit. At the age of 62, they're eligible for $1,881 a month. And these are tax-free dollars. And I know that's logical, but perhaps not always obvious. So in this example, Mr. passes away in month 2. And I use this to illustrate the fact that as long as the surviving spouse remains in the home, she or he will continue to get the same benefit amount for, again, as long as they remain in the home. And if you look at the 40 years out on the far end of the chart, they in fact can receive more is effectively a return of principal, you might think of it that way, than the original value of the home. So that is crossover risk, and that is in fact where the FHA insurance absolutely comes into play. The FHA insurance actually is in the amount of $105 billion today backing this specific program and features like this, meaning said plainly, the client can continue to draw on their home equity even if they're in a negative equity position, and that's what guarantees those payments will continue on. So again, this is the idea of the client drawing a monthly payment. The next slide is just literally from one of our illustrations to reinforce the fact that we, RMF, can put this option in place, and the credit line that we're going to look at next for a one-time cost of $125. How do we do that, you might ask? We provide a credit. There are absolutely actual real estate settlement and closing costs. We're able to provide a credit to offset that, largely because we are a Ginnie Mae issuer. These are securitized and sold into the secondary market. So we realize a gain at origination, and we're passing that through, if you will. So second option that Wade and others have really focused on with the research is the credit line. I found in working with financial advisors to see these bars helps you best understand, and some actual illustrations. I'd encourage everyone to, after this call, to get a sample quote or illustration, and you can really see the numbers. But hopefully this helps. This is the 62-year-old client. Again, same, let's assume it's Mr. and Mrs. Jones again. Rather than drawing the monthly payment, they decide to instead put a credit line in place. There's a factor underneath. It's about 52% that you would multiply times the appraised value of the home. In this case, 625.5. That's what gets you to that starting credit line of 327,500. Absolutely, there is an interest rate sensitivity here, meaning that factor is arguably at an historic high, the amount of money is available to the client. So again, one-time cost of $125. Let's assume Mr. and Mrs. put this in place. Again, Mr. passes away 7 months from now. As long as Mrs. remains in the home in year 20 or at the age of 82, she would have available to her $1,149,193. Clearly, that's a lot of growth over time, right? By the way, it has nothing to do with the value, the underlying growth calculation. That has nothing to do with any home value appreciation. And in fact, the value of the home could be the same in year 20 at age 82, and yet she still has this equity available to her. Same idea, just to expand on, we see a lot of use around this, certainly with the standby credit line for managing through up and down markets or investments. See a lot of use with clients that have no long-term care insurance as a way to liquefy, and I like how Wade puts that, to liquefy another asset to help for that purpose. Also see a lot of interest from planners and advisors where they realize that this can provide basically another deferred income vehicle. So in this example, the same credit line amount from the previous slide, the $327,000 or so, all I'm showing is two different possibilities. Let's just look at age 82. So at that point in time, when the client now has a credit line of in excess of $1.1 million, here's the idea. They could take the growth that happens at that point in time. It's going to be literally over $67,000 a year. They can turn on an income stream every year and still have this, I think you would agree, a pretty large credit line available as well. So the idea being, if you set this credit line early, as Wade generally recommends, at some future point in time, you can turn on an income stream and yet still have access to a large amount of monies in the credit line. So with that, Wade, I will hand it back and encourage questions. By the way, as you like, you can feel free to start posting questions. So Wade, back to you.
Okay, thanks. Okay, let me get up to the slide we're on here. And so now that I've could spend a lot more time explaining how reverse mortgages work, and really it's not something that you can pick up solely in 15 minutes, but I want to make sure we do have time to discuss the uses for reverse mortgages. So we've got a very basic understanding of how they work. Now, how can reverse mortgages be used in a retirement income plan? And so this is a spectrum of uses that I came up with, 4 general categories for how somebody might want to include a reverse mortgage in their retirement plan. The first category, and these are ranked the top to the bottom, are more strategies that are going to spend the principal limit or the proceeds from the reverse mortgage, spend them more quickly on top, spend them more slowly or possibly not at all on the bottom. So on top, paying off an existing mortgage. Transitioning from a traditional mortgage to reverse mortgage is basically paying off the existing mortgage, but then voluntarily continuing to make your usual mortgage payments to try to pay down the reverse mortgage balance and allow for more line of credit. Funding the home renovations to allow someone to actually stay in their home, because many Americans do want to stay in their home. The American College recently did a survey where for people aged 55 to 75, 60% of the respondents said they hope to stay in their home as long as possible. That may not be possible if the home is not designed to age in place, if there's no handicapped entrance, wheelchair entrance, or a whole list of things that can be done to help make sure that the home is livable for a longer period of time. The reverse mortgage could be used to fund that. And then there's a HECM for Purchase program to actually purchase a new home through the HECM program so that you basically, whatever the principal limit is, you pay less than the full value of the home, and then the home serves as the collateral for the loan in the same sort of way as with other reverse mortgage uses. The next general category is to coordinate from retirement spending between the reverse mortgage and the investment portfolio. And that's really where the research got going in the financial planning world. I'll talk about that. This is one of the important areas. So the different strategies here, spending the home equity first, that is a riskier strategy. You're really leveraging the investment portfolio, spending down home equity, letting the investments ride and hopefully grow, although they might not always grow. So this is a riskier way to coordinate spending. But then there's the coordinated strategies, and there's two different strategies I'll talk about, where you only draw from the reverse mortgage when the investment portfolio is down as a way to try to help manage sequence of returns risk. And then also using tenure payments to cover part of the retirement expenses that reduce the need to take as big of distributions from the investment portfolio. And by lowering the withdrawal rate from the investment portfolio, you are reducing sequence of returns risk. The next general category is just trying to build in retirement income efficiency improvements, and the reverse mortgage can provide a way to do that. So the tenure payments as an alternative to annuitizing part of the portfolio. People who want to delay Social Security but need to cover, if they're already retired at 62, they want to delay to 70, they need to cover those 8 years of missing Social Security benefits. The reverse mortgage could provide a way to do that. It can be a great idea to do Roth conversions, especially if someone's already retired and is in a low tax bracket in those early years before age 70, and the reverse mortgage could provide a way to pay taxes for those Roth conversions. And then also somebody may have a pre-existing long-term care insurance policy, and some of the bad news from that side of the world is those premiums have tended to increase in unexpected ways. You can't use a reverse mortgage to purchase other types of financial products, but this example is you had a pre-existing long-term care insurance policy. Premium increases are making it more challenging to continue to maintain that policy. The reverse mortgage could provide a way to maintain that policy. And then using the reverse mortgage line of credit as an insurance policy. That could be opening the line of credit but letting it sit in case the portfolio is depleted, and then support retirement spending from the reverse mortgage. Or it could be to protect the value of the home. These things that are bold-faced and asterisk, and with asterisks I'm going to talk about more in the presentation, and also some that don't have that, so that'll be an additional surprise. And then also just as a source of contingency funds for retirement spending shocks, so that unexpected expenses related to long-term care in the home, not at a nursing home because you have to stay in the home to be eligible, but in-home care. And this may be the reverse mortgage could allow somebody to stay in their home longer than they might otherwise be able to do without the reverse mortgage, covering health expenses used as part of a divorce settlement and so forth. So now let's go into more detail about some of these uses. So coordinating spending from the investment portfolio. And this is where the research in financial planning really got started. It's part of the cultural zeitgeist. There were two separate articles where the authors did not realize that these two different sets of research teams were working on the same general topic at about the same time. They didn't know about each other, but they have different approaches, but they both basically had the same idea. The thesis of these two articles from 2012 was that using the reverse mortgage, the line of credit strategically can create retirement income efficiencies by helping to manage sequence of returns risk. And the first article to make that point was the Barry Sachs and Stephen Sachs in February 2012 in the Journal of Financial Planning, where the article was called Reversing the Conventional Wisdom, because the conventional wisdom, the idea that this reverse mortgages had this bad reputation, the conventional wisdom was that you didn't want to touch them unless it was absolutely necessary. So it was, if people ran out of all other assets and had no other options, then the reverse mortgage gets used as a last resort. Open the line of credit and start spending from it once everything else has failed. And the point of their article was that's actually the worst possible way to treat home equity as a part of a retirement income plan. And I've replicated their research. I'll show the findings. Yeah, I confirmed that point, that this last resort idea is the worst way to think about a reverse mortgage as part of a retirement plan. And then at Texas Tech University, John Selter, Harold Avinsky, Sean Pfeiffer made the same general point. Strategically use the reverse mortgage. They both had different ways of when to draw on the reverse mortgage. With Sachs and Sachs, it was a basic, any year after a market downturn, you draw from the reverse mortgage, which is also how this strategy gets discussed in the world of life insurance. Any year after a market downturn, draw from the cash value of a permanent life insurance policy. The same basic strategy. The Texas Tech team had a more sophisticated strategy where they calculate a glide path of, given that, say, you want your portfolio to last until age 105, they track out how much wealth do you need each year up to age 105. If you have more than your glide path shows that you need, then you don't borrow from the reverse mortgage. And actually, if you already had a loan balance, you start repaying that loan balance. But if your remaining portfolio balance falls below the glide path, showing how much you need, and it's not just the glide path, but they figured 80% of the glide path was a key point of, if you fall below 80% of the glide path value, then you start spending from the line of credit to avoid having to sell other assets at this significant loss related to your portfolio underperforming what you expected it to do at that point in time. So I've replicated their studies and added some other strategies. So the next couple of slides have 7 strategies. The first is not a comparable strategy. It's just to really set a baseline. If you completely ignore home equity, what happens? But the other 6 strategies are all comparable because there's 6 different ways to use home equity. Home equity as the last resort, that's that conventional wisdom idea that you do not open the line of credit until you've actually run out of money, your portfolio is depleted, and you have no other choice as a way to get spending power. And then the next 5 strategies are all going to open the line of credit at the beginning of retirement. That's the difference. Home equity as a last resort, you do not open the line of credit until you actually need it, which means you're not going to get as much line of credit growth. The next 5 strategies, you open the line of credit as soon as possible. And then you can spend home equity first. The Sachs and Sachs coordination strategy, the Texas Tech, that's the Salter, Avinsky, and Pfeiffer strategy. Use home equity last is you open the line of credit early, but then you don't actually spend from it until the portfolio is depleted. So that's the difference between use home equity last and home equity as a last resort, again, is use home equity last. You open the line of credit early and just don't spend from it until it's needed. Home equity as a last resort is you don't open the line of credit until you actually have to start spending from it. And then the final strategy, use the tenure payment option. And so this, I think, is a pretty compelling set of results here. Let me pull out this arrow to point to things. So this black curve, so for a retiree who has $1 million at retirement, they're 62 years old, they have a $500,000 home, they want to be able to spend 4%, so $40,000 a year net of taxes. They have a 25% marginal tax rate, so that means they really need like 5.33% to be able to also cover their taxes. Here's the probability of success over time from Monte Carlo simulations I did using my standard simulation models that account for the low interest rates today. They're not simply based on historical averages. Well, if you ignore home equity, the probability that this financial plan, this $53,333 pre-tax spending goal from $1 million, the odds of it working over time fall dramatically. But this strategy with the black curves, again, it's the one that's not comparable to the others because it doesn't use home equity at all. It just lets home equity sit there. But now we're talking about strategies that are comparable. The next one going up here is the home equity as a last resort. So you don't open the reverse mortgage until it's needed. Now that just incorporates a new asset of home equity, so that does improve the success rates over the ignoring home equity. But what you can see is that, again, the same point that Sachs and Sachs made, this is the worst possible way to use home equity as a part of a retirement plan. Assuming you actually use home equity, this is the worst way to do it. You get higher probabilities of success if you open the reverse mortgage and spend from it first as a way to leverage your portfolio. So it's a riskier strategy. It is an improvement over the last resort, but it's the riskiest of the remaining strategies. Then you continue improving probabilities of success with the tenure payment option. So that's the guaranteed income for as long as you remain eligible and in the home. The two coordinated strategies behave pretty similar to each other. You see slight differences. The Texas Tech strategy comes out slightly ahead later in retirement. And then opening the reverse mortgage at the beginning, but using it last gives you the highest probabilities of success. So this is compelling evidence that I believe that using a reverse mortgage in a coordinated way can help to dramatically increase the probability of success for a given spending goal in retirement. Got to get the arrow turned off to go to the next slide now. Let's see here. Let's see, what do I do to get the, here we go. Okay, so then, well, it's not just the probability of success that matters. And in my writing about retirement income, I spend a lot of time arguing that the probability of success is not the most useful metric. In particular, it's not so bad for this study, but for when you're looking at things like partial annuitization, it really falls apart. So there's other ways to look at these matters as well. This is just what's the median legacy value. What's the median amount of assets that would be left for the next generation, where the legacy value, I mentioned this earlier, it's the value of the home minus the loan balance due plus any investment assets. What's the combined legacy value for the different strategies? And you can see again, and now I'm leaving out the ignore home equity in this one, but you can see that reverse mortgage is a last resort coming out on bottom. You're getting, what you're seeing here is, well, the coordinated strategies coming here, then you've got using home equity first, because this is a way to leverage the investment portfolio. On average, investments, this is assuming a 50-50 portfolio of stocks and bonds, on average it will grow faster than a loan balance, so that on average you're preserving more legacy by spending home equity first. Now, on the downside, that may not be the case, but on average, that's the case. And then you have the tenure payment, and you have this interesting phenomena, which is also going to show up, and also shows up here, where these lines level out somewhat. That's being triggered by the non-recourse aspect of the reverse mortgage, that the borrower does not have to pay more than the value, the appraised value at the home at the time of repayment. That's what the mortgage insurance fund, that's one of the guarantees it provides, is that this is a non-recourse loan. So that tenure payments, while you're seeing tenure payments start to shoot off in this higher direction, that's coming at a point where the entire principal limit has been filled, and is covered by the value. Basically, you can continue to get the tenure payments even if the loan balance is bigger than the value of the home. So you're basically getting quote-unquote free money at that point. It's not having any negative offset to your legacy. That's also why this spending from the home equity last flattens out here as well. You continue to be able to spend, but you are not having any negative impact on legacy because of the non-recourse aspect. It's not being subtracted anywhere from the amount you can leave to the next generation. And then this is the 90th percentile when markets are doing really great. So that's where using reverse mortgage first really helps out a lot. And this is the 10th percentile where markets are doing very poorly. Let me just keep going to make sure we have time to get through everything. The next topic I want to just talk about briefly is paying off an existing mortgage. So here's an example about a 65-year-old couple going into retirement and they still have a mortgage. What should they do about it? What should a household that's carrying a mortgage into retirement do? So in this simple example, 20 years ago, they bought a $300,000 home, 20% down payment, using a 7.5% fixed rate 30-year mortgage. Now they could have refinanced that at some point. I've also played around with refinancing. It doesn't really impact the results too much because when you're getting to those last 10 years of retirement, you're mostly repaying principal at that point instead of interest. Most of the interest payments are more upfront when interest rates were still higher. But in this example, they've got, so they're 20 years ago, so they've only got 10 years left on this mortgage. Their annual mortgage payments are $20,321. 10 years left on the mortgage. Now they're 65. The remaining mortgage balance is $139,485. Assume that their home grew in value at 3% a year for these past 20 years, and so it's now worth $541,000. So if they open a reverse mortgage at age 65, in the current low interest rate world that we're in, their principal limit factor, the percent of the home value they can borrow is 52.6%, or that's $285,000. Now, to fully understand reverse mortgages requires more than that 15 minutes I spent, but basically if you can keep your initial borrowing to under 60% of your allowed borrowing amount, you can pay a lower upfront mortgage insurance premium. And I was just checking to make sure to be able to repay the balance, the mortgage balance, $139,000, they can do that at less than 60% of the initial principal limit. So they repay their reverse mortgage. They pay off their mortgage. $139,000 from the reverse mortgage pays off their mortgage, eliminates that 10 years of mortgage payments, and still leaves them with another $140,000 or so of a line of credit that they can use for other purposes. And now I just test with my simulations how do different strategies perform in terms of considering to repay that mortgage. The probabilities of success are the highest for the using the HECM to pay off the mortgage and then use the line of credit as a last resort option for if your portfolio is depleted. I shouldn't say last resort, but you have some line of credit left, but you're only going to spend from it if your portfolio is depleted. But you pay off the mortgage with the reverse mortgage. That gives you the highest probabilities of success. The next strategy would be to just simply, you keep the mortgage for 10 more years. If you're keeping the mortgage, you can't open a reverse mortgage. But what I'm assuming is after year 10, the mortgage is paid off. 10 years into retirement, you open a line of credit and then spend from it if you've run out of money. So use reverse mortgage last, opening it 10 years into retirement, which is the soonest you can do if you're not going to repay the mortgage from the reverse mortgage. Higher probabilities of success. Here's what happens if you're just trying to do the more like the conventional wisdom of not opening the reverse mortgage, only using it as a last resort, but keeping the mortgage into retirement. Sequence of returns risk means portfolio returns early in retirement have a disproportionate impact. Having to spend an extra $20,000 a year for the first 10 years to repay the mortgage is amplifying sequence of returns risk, and that's what's really pushing down probabilities of success, having to repay that mortgage and not having that growing line of credit. Well, if you had $1 million at retirement and you pay off the mortgage, you get slightly higher probabilities of success than if you kept the mortgage, because then you run the risk of your portfolio losing value, but still having those fixed repayments to make, which means taking out a bigger percent of what's left to cover that. So you're looking at strategies here, not using reverse mortgage, much lower probabilities of success than, again, what's the best strategy here, which is pay off the mortgage balance with the reverse mortgage and then use the line of credit to last for other retirement expenses. Okay, so let me get the pen turned back on. Tenure payments as an annuity alternative is another interesting issue that we can think. So I'm a big fan of income annuities for retirement income planning. The tenure payment behaves in a similar way as an income annuity, although there's some important differences. So let me just mention the similarities and differences briefly and then show how the tenure payment can impact a retirement plan. So tenure payment, it's this guaranteed income, and often you might fall into the trap of saying for life. With the tenure payment, it's not necessarily for life. If the person has to leave the home to go into a nursing home, the tenure payments would stop. I mean, there has to be one eligible borrower in the home to continue these payments. So income while eligible versus income for life. It's just a caveat. The income annuity does pay the income for life. Doesn't matter where you're living. They have different calculation formulas. With an income annuity, it's based on your age, your gender, the yield curve of interest rates, and then mortality projections to try to calculate the survival weighted discounted cost of a particular spending stream for life based on your age and gender. The tenure payment is different. It's a simpler calculation. It's going to be based on a higher interest rate than the yield curve because it builds in all the lender margins and things. The higher interest rate allows for more income, but it's also going to be just calculated through age 100. It's not based on actual mortality data, but assuming the person lives to age 100. That fact would lead to less income, while the higher interest rate is a much bigger impact than the age 100 factor, so that tenure payments will provide more income as a payout rate of what you're annuitizing. So as a payout rate from your principal limit, the tenure payment has a higher payout rate than an income annuity would offer by annuitizing the same amount of assets. Now, the tenure payment, there's no lump sum premium. With an income annuity, you pay an upfront lump sum premium to receive a guaranteed income for life. You do not have to pay that premium with the tenure payment. It's just each month as you receive your check for the tenure payment, then it moves from your line of credit over to your loan balance and will start growing at the loan balance, but it doesn't get into that loan balance until it's actually received. So there's no upfront premium. And then just the behavior would be more like an income annuity with a cash refund provision, because if your retirement ends up being short, unfortunately, you've only received a little bit of income from the tenure payment. You would not, and the loan balance will be small. It would be kind of like getting a cash refund on an income annuity. Income annuities have the mortality credits. Tenure payments have, I put mortality credits in quotation marks because there is a kind of mortality credit, but it's not a traditional one. It's based on the non-recourse aspect of the principal limit and the home value, where you're not on the hook to repay more than the appraised value of the home. And those tenure payments can continue even if they've exceeded the available principal limit. So that means if you do end up having a long retirement, you can easily receive these mortality subsidies, in this case from the mortgage insurance fund, rather than from other borrowers, which is, well, it is one of the potential risks to the taxpayer from a reverse mortgage. And with that, so this slide really surprised me because, as I mentioned, I'm a big fan of income annuities. And here's the strategy I'd be talking about with an income annuity all the time. That's you partially annuitize your nest egg, and then you treat the annuity allocation as part of your fixed income so that you increase the stock allocation to account for the fact that basically you treat your annuitized assets as part of your bond holdings. This yellow line has a higher probability of success than, well, using an income annuity but not changing your stock allocation, or just not using an income annuity. And in all these income annuity cases, you use a reverse mortgage as a last resort option for that conventional wisdom. Well, the yellow line does better than these other two lines. I'm a big fan of income annuities. I was surprised when I did this, though, and saw that the tenure payment comes out so much further ahead on the probabilities of success than what I think is the optimal type of strategy for an income annuity. That was really kind of shocking and impressive to me that, again, this is a potential use for a reverse mortgage in retirement. And then we've got protective hedge for home values. So this is really just, when you think about a home, its price has a lot more volatility, just like a single stock versus a stock index. The stock index has the market risk, but you have diversified away from that idiosyncratic risk that each individual stock has. Well, a single home is going to be much more volatile, its price, than an overall housing price index. And so there's upside potential for the home price, there's downside risk for the home price. And basically, using the language of finance, the HECM, opening the line of credit, can behave as a put option on the value of the home. That is basically protecting you with a line of credit that you can spend from if your home falls in value. The line of credit does not fall in value just because the home falls in value. And the fact that the HECM is a non-recourse loan is the important driver of that. So here's just assuming the low interest rate world that we're in today, but assuming that interest rates don't ever increase in the future, here we're looking at the evolution of the home value as this top curve growing at 3% a year, and then the evolution of line of credits with different lender margin rates. If interest rates don't increase in the future, you see that even before age 90, but it takes till the late 80s, eventually the line of credit will grow to be worth more than the home value. The government set this up to try to just say the home is the collateral for the loan. Generally, the borrower is not going to end up racking up a bigger loan balance than the value of the home. But if you start to introduce the risk for home price fluctuations and for, well, in this case, the potential for interest rates to also increase in the future, let me just skip to the punchline for that. I've done Monte Carlo simulations just trying to show what's the probability that the line of credit can grow to be worth more than the home value, accounting for interest rate changes and home price changes in the Monte Carlo simulations. And I find that by age 82, for someone who opens a line of credit at 62, by age 82, there's a 50% chance that the line of credit could be worth more than the value of the home. And that's just a way to protect the value of the home. That would be one of the insurance aspects of the reverse mortgage. So to wrap this discussion up and to leave a few minutes for questions, so the conventional wisdom was really wrong about reverse mortgages. They shouldn't be used as a last resort option. Strategic use of the reverse mortgage can improve retirement sustainability, can support a larger legacy. It works because of this growing line of credit and this ability to mitigate sequence of returns risk. The low interest rate world that we're in is actually a big attraction for reverse mortgages, unlike most other retirement strategies where low interest rates hurt. It actually helps the reverse mortgage. And reverse mortgages are really something that can help responsible middle-class retirees because the benefits are going to be bigger when the home value is large relative to the portfolio size. So if you've got a client with a $500,000 home and $1 million portfolio, well, there's a lot of value that can be had with the reverse mortgage. If their portfolio is $500,000 and a $500,000 home, well, that might be an odd ratio. But then the reverse mortgage would provide even bigger relative benefits. And then responsible use of this HECM reverse mortgage can improve the retirement income efficiency. That can be shown in a lot of ways. I'll stop talking here, and there are additional slides that explain more about how reverse mortgages work. I think the slides are emailed to everyone so that you can look through this part later at your leisure if you'd like. And let me wrap up there for Tom, if you'd like to come back on, and if any questions have come in, happy to talk about those.
Great. Yeah, thanks, Wade. Well done, of course, and a lot of very helpful insights here. So again, folks, please feel free to post your questions using the question panel with GoToWebinar. So far, I have a question from Gordon. Relates more as to the mechanics of the product. Specifically, Gordon asked if a client were to put this a HECM in place and unfortunately had to move out of the home for care. What happens then? The simple answer is that if a client uses a HECM, be it a monthly payment option or a credit line or what have you, if it's a husband and wife and only one of them moves out of the home for skilled nursing or what have you, as long as one of the spouses remains in the home, everything continues as is. If both are out of the home for more than 12 consecutive months, and that's a key point there, then the HECM becomes due and payable. That's what would trigger what you might think of as a maturity event. So again, that's the question there. By the way, Wade mentioned several times, of course, this is sort of a primer. I would encourage everyone, if you want to learn more, in the survey that I believe NAFA will present at the conclusion of this. There's a question if you'd like to talk to an RMF rep to get further educated. You have that option. I'd absolutely encourage you to do that. So again, just to put a plug, I think you would really find that helpful. Let me go back to the question. So from Rich, so good question, Rich. Does the home value have to be under $625,000? No, is the short answer. Is Wade alluded to. The home could be worth $1 million or $2 million, but the amount available, again, there's a factor. That 62-year-old today, in today's interest rate environment, it's about 52%. You multiply that 52% by the lesser, and that's the key term here, the lesser of the appraised home value or the FHA limit of $625,500. So again, in that case, if it's $1 million home, we're multiplying 52% times $625,500 versus $1 million. Next question from Rick is Rick here, not Rich. I'm sorry. Generally, what is the effect on results of lower marginal tax rates? I'll take a stab at this, Wade, and then hand it over for comment. I would tell you every case that I've modeled in Money Guide Pro and any program, I think you're going to find the same, where you have clients that have a lot of money held in qualified accounts in particular. The use of a HECM, especially the monthly payment option, absolutely can lower their tax bills and lower their tax brackets. So it's a great, I think it has potential as a bracket management strategy as well. Wade, anything you'd care to add to that?
Mm-hmm. Yeah, since the HECM proceeds are like the proceeds of a loan, so it's not taxable income. It doesn't go in the AGI. It's kind of like taking distributions from a Roth IRA. So in terms of the research I showed, the marginal tax rate, I was assuming when you're taking from investments, you are taking from an IRA and having to pay that marginal tax rate. If the marginal tax rate is lower, that would improve probabilities of success for investment strategies because you're paying lower taxes. That's how it would have impacted the simulations I showed. But I agree with Tom that just like with a Roth IRA, you can really manage tax brackets to avoid going into a higher marginal tax rate as well by strategically spending from a HECM.
So follow-up question, a couple of questions coming in, and again, feel free to fire away. Next one from Steve on the follow-up to if both owners are out of the home, can a HECM be used for long-term care? And the answer is no. What I would say is, what I would share is I see a lot of planners that set this up as, again, especially where they have clients that by choice or by default are self-insuring for long-term care risk. So one of the first cases, what I wanted to share is one of the first cases involved a 82-year-old couple, and this is a great example where this can really help. The husband had to be moved out into care. The fee for that was $60,000. They had an IRA at the time of $250,000 and a home worth $250,000. Well, the wife wanted to remain in the home, was able to look at using a credit line as a resource versus drawing way too much beyond their RMD out of their IRA, and could use the funds to do just that. So there's an example of where it can work. Next question from Norman, is the interest for the loan tax deductible? It's generally, I have to say, you have to consult your tax advisor, but it's really handled when paid is when you would have the likely deduction. Again, Wade, would you like to add to that?
Right, yeah, so that there could potentially be a big tax deduction when repayment occurs at the end of the loan. But yeah, this is complicated, and the tax laws about how reverse mortgages work, it's a complex issue. So Tom Davison and Barry Sachs are two individuals that have spent a lot of time actually researching about the tax implications of reverse mortgages. It's complex and definitely is something to consult with a tax professional about.
Yeah, so next question from Edward, a good one. Edward, our firm, RMF, is licensed in all states almost, but New York at this time. We've had our application in for a long time, and New York just does things certain ways. But if I can be of any help to you, we have loan officers all across the country, and again, where we don't, like in New York, I can certainly help you find a qualified party. So again, my contact information's in there. Feel free to reach out to me. And I work with advisors, again, all over the country, and happy to help in any and all ways. Next one from Stephen. What are your opinions on the HECM for purchase when you eliminate mortgage payments on purchasing a home? I think, in fact, I'll just give you a tease. We have some research coming out on that option as well. So said simply, for everybody's benefit, if you have clients that are right-sizing or downsizing, they can use the HECM to finance approximately 50% of that purchase price. So interestingly enough, I had a call earlier today from a Merrill Lynch advisor on a case just like this, where a client's sister is looking at selling possibly her home worth $450,000. She owns it free and clear. She could take that cash and buy, let's say, a $600,000 home, and take $300,000 out of the $450,000 that she netted, put it towards that purchase price, and then use a HECM to finance the balance of that. So it's a little, most advisors are unaware of that. I think, like with all these scenarios, it's one client case at a time. Again, where I've run numbers in Money Guide Pro, I've seen that to be very compelling. I just put up back on the screen just a sample, what I term as an illustration, refer to it as an illustration to kind of point out the growth. This is something for everybody on the call. I would strongly recommend that you get a sample. It could be a fictitious client. It doesn't matter. But I think if you actually see something like this, it will really help you better understand how this works, how the growth works. This is a case where the clients are, I believe, 65 today. This is an actual case. They start with a credit line that at the end of year one grows to $360,000. And this is, what we call the amortization schedule. And as you can see, at the end of year 10, they now have $635,267 available. So for every client case, we will run illustrations and examples like this. Gladly do that for you. I'd encourage everybody, again, partake in the survey. This is something that I think can really help you best learn how this works. And again, just to kind of emphasize that the cost to put this in place is literally $125 at the end of year one. If they haven't paid, for part of that, you have to have $50 on the line to keep it open. They'd have $8 in carry costs, so not a significant cost. So again, we'll make another call for questions here. So make one last call for questions, and certainly welcome your feedback on today's webinar and Wade's content. I think it's outstanding, and it's certainly been very helpful in our effort to educate advisors.
Well, thanks, Tom and Wade. And as Tom had mentioned, there will be a brief survey right after the webinar. So I invite you just to keep your computer open for another minute or two as that survey is launched right when we close the webinar. And I want to thank all of our webinar participants for joining us today. And especially want to thank our presenters, Dr. Wade Pfau and Tom Dixon, for enlightening us on this extremely important topic for our clients. And this concludes the webinar.